All right, there we go. Let's try this again. Good morning, everybody. Had the wrong settings on there for a second, so I had to reset the stream. Go. Cat. Give me a moment to put everything in the places. We will get started. All right, I think everything is up and running correctly this time. Should be good to go. All right, so today we're going to be looking at Corsair Gaming. Pretty cool company. Probably going to be a somewhat briefer stream this time around, just because there's way less financials to do for it, and I've actually already got a evaluation of them in my old spreadsheet template. So it's which I already copied the numbers over. So really, we just have to fill in fiscal year 2020 and put some projections out, and a few of the other numbers. And I did a lot of the stuff already, so we just have to fill in some stuff essentially. I'm not even going to listen to the earnings call. I already did, because I'm not even sure. I don't know how long it is, and so I don't necessarily want to cut it short. But yeah, so this shouldn't take too much longer. I'm pretty familiar with the company just as a consumer. I've got lots of Corsair products myself. Got a Corsair keyboard right here. I have a Corsair mouse, although that's not the one I'm using, but I do have a Corsair mouse over there. I have a Corsair case to my computer, Corsair CPU cooler, Corsair memory, decent amount of Corsair products. So. Not, but I mean, they have a million other products too. So, but yeah, so they finally IPO'd last fall. I think it was like early October or late September, whatever it was. Late September. 9/23 was the first day of trading. 9/24 being the first day that we have closing on. Pretty cool, and I valued them within within a month of their IPO. But it was with my old spreadsheet template that didn't quite have the same level of variability between models, and so it wasn't able to really capture a lot of the potential upside versus some of the downside, and it definitely had some other older features that made me value it a little bit differently. So it's very possible that I had it pretty wrong, which the market certainly would say that I had it wrong, because I think I had valued it like, I mean, it was already like 25 or something by the time I valued it, because it jumped up really fast. It started around 15, but I'm pretty sure I had it valued at like $15 to $20 or something, and by the end of the year it was up at 36. It's now down to 33. So either the market's very exuberant, or I was pretty wrong when I first valued it. But like I said, I was in an old spreadsheet that didn't quite have the same level of flexibility stuff. So that is what it is, but we shall see. Like I said, I'm a huge fan of their products. I've been for a long time, so I definitely would like to keep a close eye on them. So yeah, shouldn't take too long to do this though, because like I said, we just have to fill in 1 year worth of financial information along with few other things, and that'll be pretty much it. The most recent 10K has RSU balance in. So not. So let's go look for it in their 10K. Financial statements. Lower in here somewhere. Product warranty, conditional product obligation, stock-based compensation. What we want. We're going to add in the restricted stock unit to the most recent 10Q share count to get their most recent share count, the dilution in it. And I would be tempted to include their stock options as well in this particular case because they have such a huge portion of them, but they do have a very long contractual lifespan, so I don't think I necessarily want to do that today, but that is something worth keep noting, that they would have that much more dilution to go into it by then, but they would also theoretically be larger by then, so the dilutive effect is actually smaller, so it doesn't actually necessarily make sense to include the dilution effect as of the moment. Restricted stock units have delayed effect too, depending on lockup rules, but they are a little bit more automatically dilutive because options aren't actual shares until they're exercised, and so because the options are not exercisable for the contractual term, then they're not actually going to have an effect on the earning collection yet. They just have a partial dilutive feature, which you would have to use Black-Scholes options pricing model to actually come up with, which I mean they do. Obviously, that's what they do when they report diluted EPS, but I'm not going to do that here. Partially because I don't have that pricing model built into my spreadsheet, but that's one thing that I hope to maybe build in eventually. So oh, whoops. Go grab the formula I was using. Hold on. Oh, I don't know why it's not a thing. Array formula. Come on, man. Just make it simple. Come on, man. Huh. I don't know why that's doing that. Oh, well. Oh, that's why I'm fucking dumb. I didn't have it all the way up, that's why I'm like staring at A3 being like, what the hell? Wasn't I doing it? Oh, okay. Remind me early in the morning. More caffeine. Yeah, we got that fixed. We got some of this bullcrap happening too, just like we did with ironwood. Might as well check to make sure that's not happening everywhere else too. Be really nice if it just gave me the second parentheses, because like if it gave the second parenthesis on the other side, it actually wouldn't have this problem. Wait a minute. Wasn't I supposed to put that as a negative? Yeah. Well, maybe I can just kind of do the math myself, but like I said, still sort of experimenting with this way of writing things out. I haven't like started building the new spreadsheet yet, but I kind of just needed to mess with it times before I start building an entire thing from the formulas up. Luckily, like I said, this one shouldn't take very long, so I can afford to, I guess, screw up a couple things along the way. Much easier to screw it up when you're only doing 1 year rather than trying to put 10 years in, like I was doing with ironwood. I screwed up several times, and still banged out within the time frame I was expecting, but I had a more full time to work on that one on Wednesday. Today I'm trying to like partially rush through this one so I can get to some other things this morning, but one of the reasons I chose Corsair is because, yeah, I already had a lot of financials already done for this one, so I knew it would be a relatively fast one to knock out. As well as somebody had suggested / requested it in the comment section a week or two ago, so figured I would put it out there. As well as it is a pretty popular one for various other channels to talk about I've seen around YouTube, so might as well put my own take on it. Okay. Income. up the 91.9. Can't remember what my core assumptions were on the old spreadsheet template that I used too, but like I did note that their margins have jumped dramatically. I may have only given them like a few percentage points of margins more in line with the previous, like, or I still probably had a variability to on it where it may have been like half as much up to like 2 or 3 times as much, but 8.19% on the corrected net margin, which is a margin corrected for a capitalized R&D uh, in the last year, is a dramatic improvement. So that definitely opens the door for them to possibly be a lot better than, like I said, I had put out last fall. But was like I said, an earlier spreadsheet template. I knew it wasn't as good when I was doing it. Into debt. Okay, have any selective non-cash to capital. Property, plant, and equipment. Acquisitions. Fees from initial public offering. Costs. Sizing of stock options. Poodle. Wait. So pretty good equity cash flow. Higher than last year, though not necessarily as high as the previous year before that. But that's partially because of cash flow generative effects. They were actually paying down their debt, even though they were also issuing shares. They still had positive equity cash flow, so that's pretty good. But they did obviously issue a bunch of shares, so it kind of wipes that out. Effectively speaking, it's like a negative 8.63% common yield, and they're probably gonna issue many more shares in the future, or at least they would probably be dumb not to. So whether they do or not, I guess, is up to them. All right, balance sheet, marketable securities. Bulls. Stories. Paid expenses plus cash. PP&E do have goodwill and intangibles. Non-current restricted cash along with other hold on. No current debt. Payable. Other. Dramatic improvement in the retained earnings, though. They'll probably have that positive next year unless they do some like massive level of investment or something. R&D here counting as investment. That's how we think about it. Well as there others been accumulative too, so that's cool. But yeah, as you can see, so like a nice solid add of about 100 million in paid in capital per year for the last few years. So I mean, easy to assume that they might issue another 100 million worth of shares or something. $100 million worth of shares, that is. All right, so there's the 1 year financials. Now, do still have to fill in things for my data sets. %6 of the revenue coming from Central and South and Latin America. 37% from Europe, which we're gonna weight Western Europe and Eastern Europe together by GDP weight. along with they include Middle East, and now a lot of companies do that. I really hate when they do that. Middle East has a little bit less overall GDP compared to Eastern Europe, but it's close enough that I'm just gonna call them about equal, just for like knowledge sake. Like Middle East makes up 3.78% of the world's GDP, while Eastern Europe, including Russia, makes up 4.61%. So about 30% larger actually in GDP, but comparatively to uh, Western Europe, which makes up 21.38% of the world's GDP, they're not that far from each other. Which is why, for example, why I have 4 of Western Europe fit in against Eastern and Middle East. A rough GDP weighting. Doing it super precise, but close enough. Eastern is 6.8. Funnily enough, Middle East actually has a lower equity risk premium compared to Eastern Europe, which might be surprising to some people compared to like all of the political conflicts that go on in the Middle East. But a lot of what goes into the calculation of these equity risk premiums by geographic region actually has to do with the default rates of the sovereign currencies. And incidentally, Eastern Europe defaults on its debt more than the Middle East does. So, as well as a equity to bond volatility proxy across the bond index of the sovereign debt relative to whatever main index exists in that nation. So, Eastern Europe has more volatile equity relative to its sovereign bonds, as well as more defaults on its bonds. But those two factors are actually closely related to each other. I'll have to like do a whole video to explain how the equity risk premiums are calculated. But I mean, at the moment, I just use a data set anyway that comes from Aswath. But I do know how he calculates it all out. I just haven't built my own spreadsheet to do it because it's kind of complicated. It requires a lot of like specific data sources, so I just go with numbers he provides every year, and then I just update it based off of the equity risk premium that I calculate for the S&P 500 with a ratio. But at some point or another, I do want to like build my own spreadsheet to calculate all that data out. At least in the meantime, it's important to know how the sausage is made. So that's how the sausage is made. Okay, so Asia 5.75. I have the portions within there. Okay, cool. Is that accurate? For some reason that looks weird to me. Whatever. Okay, so revenue equity risk 5.66. Now we do it for production, which they get a little bit more specific, which is nice. And good on them. Good on them. They didn't count Taiwan as part of China. Pisses me off every time I go through some companies' financial statements, and they you can tell which companies are where just by taking a look of which ones count China and Taiwan as the same place in their listing of revenues and production by region. Perfect example being Apple. Apple just says China, including Hong Kong, and if you like find and read down in the small print, they include Taiwan as part of China. So. Personal pet peeve of mine. Whatever. Okay, so China has 5.4. Taiwan 5.31, and global I believe is 575, 576. All right, so production equity risk is 5.17. Weight them together about 50%, which is kind of what I do for most countries or most companies. Comes to 5.42 for weighted average country risk premium, updated with a ratio of 1.01, comes to 5.48. We gotta do their debt and their data. All right, let's see if we can find their that information. If you're watching and you're new to the channel, please subscribe, like the video, all that jazz. I stream 3 times a week, most weeks, at 10:30 a.m. Eastern. Leave your suggestions in the comment below for what companies you'd like to see. I might do them, I might not do them, but you can always throw a suggestion out there. I mean, I might have gotten to this company regardless eventually, but it was suggested by somebody a couple weeks ago, so perfect example. They have the time frame payment for their debt, but book listing of it. $321 is what they're carrying it at. Okay, well that sort of makes this easier. Kind of just lucky. I don't know why, because they're not don't have a table distributing out their debt, but so you could just read it a little bit more closely in here to figure it out. But it says it right here. First lien originally 235 million term loan. Assuming they got an extension, I'm assuming that's what it says down in here. Entered several amendments. The first lien principal amount increased it by 10 million. 2017 increased it by 115 million. 125 on top of the 235, so it comes to 350 or so. Yeah. If they do this, the benefit of telling us right here though that it all comes in 2024. Yeah, a lot of companies use this little table where they show you what the maturities are for the next 5 years, and then it just says like other after that, or 2025 and later, or something like that. And you can kind of work backwards into the weighted maturity with that, but it comes out to usually be a little bit more of an estimate. But conveniently enough, it's all of their debt is due in 2024. So kind of just makes it a little bit easier. We're just kind of lucky in that case because they have so little debt and it all happens to be on one specific loan. Now, figuring out the interest rate for it, the book interest rate is a little bit trickier. I was trying to like look through greatest of the prime rate, sum of the federal funds rate plus 0.5%, 1 month LIBOR plus 1% plus a margin of 3.5%, or the greater of LIBOR and 1% plus a margin of 4.5%. The revolver board interest rate equal to or at our election the greater of the prime rate, sum of the federal funds rate plus 0.5. Yes, it's very, very complicated interest rate rules for this particular loan. As a result, the first loan Leon amendment in 2018, the first loan, term loan, the revolver margins were both changed from a range of 2.75 to 3.25 for the base rate loans and to a range of 375 to 425 for the Euro-dollar loan. Oh, okay. How nice of them to like put this at the very end right here. The effective interest rate on the first term loan is 6.45%. Yeah, I mean, I was basically going to probably come up to something like that because I was probably just going to slap the 4.5% onto the 10-year federal rate, and that was going to get me 6%. So I would have been a little bit short on that, but 6.45%, though, that does the trick. How nice of them to include it there at the very end. Now let's go see if we can find leases. They have them. Might have been further up, but they don't have any leases. Usually leases are listed before debt, but they don't have to be, I guess. These items down here are usually like the last item, so once you've looked at like a million 10Qs, you kind of recognize that things come in the same oh, here they are, same order, but here I guess they had an exception. How nice of them to list this out nice for us. 28691. Leases are effectively the same thing as debt, contractual obligations to pay specific payments relative to a down payment that counts sort of like a principal, which means effectively it's like an interest rate, and since they're contractual, they have their own maturity. They come with penalties if you break them or pay them down early, much like debt. So something to keep in mind. Leases, effectively speaking, are debt. But some specific types of companies do little tricky things where they get rid of their debt, but they take on massive leases in order to sort of hide the fact that they even have debt in the first place. And a lot of people are confused and tricked by this. Generally accepted accounting principles, GAAP accounting, is kind of slowly coming around to this idea on that. For example, finance leases are often included as part of debt, but operating leases are not. So either way, something just to keep in mind. You see this a lot with like a good example of that is like retail. Retail is a good one where you'll see that where it's like they could have bought the building and they could have bought it on debt and held it that way, but another thing that they might do instead is instead of using debt, they'll just lease out the facility that they're doing the retail in, and it's effectively the same thing. Like I said, you have contractually obligated payments. Rent is effectively the same thing as debt. So just something to keep in mind. Not a huge amount for them, obviously, relative to their book debt, but either way. So weighted average maturity for their debt of 3 years, weighted average interest rate of 6.24% on the book. Let's see what their actual interest payments are like. It's a little bit above that, which makes sense for debt issuance costs as well as like early down payment costs, so that's fine. some point or another I need to do like a stream just explaining how to calculate the type of beta I use, because beta is kind of a very controversial topic in the valuation academic community, I guess you could say. Some people just use the pretty standard form of beta that's used, which is essentially just the standard deviation of equity relative to whatever index it's on, turned into a basic level variance number that can be applied to the equity risk premium to give it extra risk relative to what it is. I use a very different form of it, kind of popularized by Aswath and Motoron, which starts with the normal beta that people are more familiar with, which is like I said, the standard deviation of the company in question relative to the equity over a 2 and 5 year period, averaged together in weightings. And then what Aswath the Motoron does is, firstly, he doesn't use just a straight up beta. He uses an average of the beta of a group of firms within an industry, and then he has like I said, this data set where he provides all those numbers in there, and then he also provides that same data for those industry groupings, which you can find lists of the companies that are there in the industries, which is how I choose to apply it to individual companies. Is I take a look, because like looking here, it's like I have a computer peripherals section as one segment, is their gaming systems segment on its own. Computer peripherals is one of the groupings by itself, but gaming systems, I'm basically choosing to say it's like 2/5 computer peripherals, 2/5 software entertainment, as well as 1/5 electronic general. And how I come up with like that particular array of things basically depends on what the companies are in those groupings. So I go look in the groupings, find comparable companies in the group, and then for the comparables that I have for Corsair, I apply it to the segment. But either way, and then you use debt to equity ratios, as well as effective tax rates, as well as cash to firm values, to essentially take the normal beta and work backwards to find out what a peer play of a company would be if it, once it's adjusted for the fact that different companies have different debt to equity ratios, tax rates, and cash levels, to find out what its levered beta would be if it wasn't paying taxes, it didn't have any debt, and it didn't have firm value, which obviously all companies do. But the point is, you want to adjust the beta for those factors of the company specifically. So you go from like 1.08 to 0.77 for advertising, and then so whatever advertising company you're looking at, for example, then you start with this beta, and then you essentially use that same formula that worked back down to this number to go back up to it, applying for the specific levels of those features for the company in question, which you can do. It's like I have the debt to equity ratio here, I have the tax rate further up in the thing, as well as the cash levels are applied inside the debt to equity ratio. So you can use this formula essentially to go from this to that, create your own custom beta for the company specifically, so that you can essentially create your own comparable company essentially. And there's a few other variant levels of doing basically the same process, where I'm doing it with that one form, using an average of the last 5 years as well as using the standard deviation of operating income to come up with an operating form of beta, which is usually much more volatile. But the whole concept of beta is not that the price is volatile per se. That's more of the CAPM way of thinking about it. But you think about prices over the long run as applying to the change in the earnings over the long run, then operating income and the standard deviation thereof sort of makes should in the long run be relatively comparable. But operating income tends to be much more volatile even than price over the short run, so that's one thing to keep in mind. And then essentially averaging those things together, as well as using the base average of the market as a whole, and then working backwards using the same method to come up with a market-based beta, averaging all 5 of those together to come up with the levered composite for the industry, and then unlevering it again to come back to the base level again, which is what I apply to individual companies. So it's a whole complicated process. Would have to explain it in much bigger depth, but this wasn't going to take as much time, so I had some time to sort of cover it. do. And then never actually adjust the revenue weights. There we go. Same thing with this. Massively up their gaming components and systems segment. Nike. Nice. Yeah, 68% that segment now. Pretty big change. Okay. So as I was saying, so the unlevered beta for their particular industrial grouping based off the comparables of their segments would be 1.21, and then based off their debt to equity ratio of 12.15%, and the tax rate and interest rate that they have. While we check the interest rate, let me check the tax rate. Paid 8.53% over the 3-year period. It comes to an average of 5.86%. I'm going to go ahead and actually just leave it at the 1 year because they do have deferred tax assets, but they're also increasing their profit over a pretty consistent basis now, so that's probably a better representation. Don't get too attached to that yet. But yeah, so that means after, like I was saying, calculating backward with the formula, you use backwards from the unlevering formula, you lever back up to a beta of 1.34%, which applied to their country risk premium of 5.42, come up to a total risk premium of 7.27, plus the risk-free rate, you come to a cost of equity of 8.77%. And then they have a very tiny amount of debt compared to their equity, so the weighted average cost of capital is only a little bit lower than that. They have a book value of debt of 355 million, which comes to 374 million on market value, and then the market value of their equity is like 3 billion. So yeah. Okay, we start applying some figures. Worst case scenario for their debt to equity, might assume that their equity value gets cut in half, as well as maybe doubling their debt, which would actually come up to about 50%. So that's actually probably not a fair, or probably not an unfair assumption to make. And then on the sort of best case scenario, we can probably assume it actually goes to 0, which does actually lower the value of their equity, because you would want them to take on a huge amount of their debt. I suppose, well, let me think about that a little bit further, because if they double their equity value to like 6 billion or so, quadruple their debt, that would put it at like 25 You could maybe argue that that's a possible outcome as well. And considering that they're going to have to do a lot of growing in order to achieve that, that's maybe not the worst assumption, but they have been paying down their debt. I don't know, I think maybe I'm just going to leave it at like 10%, be a little bit on the safe side, because that would still require them to issue a huge amount of debt. Maybe a 15 for the analyst number, which does pull down their, as according to the other set things that we have set up. We still have other things to adjust, but according to like how it currently is set up, that would make their value actually go down, and that's partially because we have to, especially because of this one right here, we have to adjust sales to capital ratio. The defaults I have in line is definitely too small, as peripherals typically have a relatively large sales to capital ratio, which actually I didn't get those factors in. Industrial grouping of sales and capital would be like 1.46, which they were much more in line with prior to their IPO. In the most recent year, there was much higher than that, partially just on probably on the back of very strong COVID numbers and a little bit boost to their reputation just for doing the IPO in the first place. But I'm okay with probably leaving it with a 3-year average as a result, but we definitely need to boost this up, maybe 0.75 on the low end, which that also seems like it dropped it, but that's sort of an illusion because we haven't covered all the other factors yet, so don't freak out about that. We haven't done revenue growth yet, so that's part of the reason why. Gosh, my gosh. All right, industrial grouping net margin of 16.03, which again, they had a pretty significant climb in their net margin, 2% to like 8% in this most recent year, which might be an outstanding one for them to have this particular year. It may not hold that specifically, but if I had to guess, like I was saying before, the sales to capital ratio is probably higher than it's going to be in future years, so that part probably is going to trim downward. But if one of them is going to hold steady, it probably is going to be the net margin. So maybe put the high end up to like 25%. The low end maybe down to 5%. definitely quibble with these numbers a bit. It's down to there or up to here, or, you know. Returns on invested capital prior to the IPO was in like the 8% range, and then the most recent year we had a really outstanding 24%. Like I said, they're probably going to be issuing more shares in the future, and if they're smart, they'll also issue debt, but it's just a question of getting the right credit rating to be able to issue it at low costs. So it's hard to say exactly where that's gonna pan out in the future. It's probably safer to hold at the 3-year average, but I would consider maybe the 2-year average. Definitely not going to use the 1 year. That's probably too high. We'll just leave it at the 3-year average. All right, normally I start with revenue and work my way down, but we kind of went the opposite direction this time. Doesn't really make a huge difference, but that's the real question. Real question. So what to slap on for revenue based off of their projections for net revenue this year. Should be expecting them to do like 18% or so, I believe it was. We'll just say on like the high end of things, 2.1 billion over the 1.7 billion. 23.5% on the high end is their own guidance. Since Q1 2019 to Q1 2021, it's been a 47% CAGR. That's the CAGR on the Q1 revenue, though, which can be a little bit misleading because of seasonality, though. But it is a really rapid growth in their secondary segment. And it is a pretty significant TAM with them having a strong market share. So, but that's also just this 1 year. That's not to say that it's going to continue quite like that. Obviously 2020 and 2021 are kind of different outsized years for the amount of revenue that computer and computer peripheral companies are likely to have. Pretty much every company in those groupings are expected to have major slowdowns in their revenues numbers in future years. And if you look at like the analyst numbers that are out, you can basically see that. I mean, they're not going to have a declining revenue in the following year, but it's expected to have a significant slowdown. There's like having the 18.9% here, and then only 6.7% is expected for the next year, or at least according to 9 analysts. And incidentally, and curiously enough, they're only expecting EPS growth to be 10.63% for the next 5 years. EPS growth would be post all of the share issuance, though, so that could be part of it. Pricing metric, that's it. It's hard to say what the cogger is going to be. That's just the definitely the tricky part. Um, maybe on the high end they can sustain 25%. On a distributed basis, it'll come to 10.63%. Because, for example, if they do hit their revenue expectations for that, and then they also hit the analyst revenue expectations for the next year, or actually, what was the high end? That's the real question. 2.33 from 2.1. About 11%. Assume they sustain maybe double the growth in 3 years past that. For return markets, then it'd be 50%. 50% compounds down to like 0.5%. So I'd say that's probably more than fair. It does get us the 2.1 billion in this year, but then it assumes that they can sustainably achieve that same growth rate at a pretty fast clip relative to what they've been kind of doing for the last couple of years. Possibly too much, to be honest. Which that would make that a little bit lower than 2.1 billion, but it would mean that they would be able to achieve that same growth rate for each year following that, and that's the part that's a little bit tricky. And you might be like, oh, well, they grew 55% last year, and it's like, yeah, well, it's also year 2021 or year 2020. So what's the likelihood that they're actually going to be able to do that every single year? I mean, they do have very, very strong market share, and it is a growing field, but there is a lot of competition in that field too. There's a lot of very, very small companies. They very well might acquire a lot of those small companies. So it's a little bit hard to say based off the analyst numbers, like we were saying before. That might come to 10% or so, 8.5%, but we'll go with a little bit closer to the high end, so we'll put that in. Low end is probably not zero. That part's for sure. So that much on the best case scenario, we'll pull down that. It's definitely tricky, hard to say. You could argue that this should be 25. You could also argue this should be maybe 10. I would do both. That's the thing. I don't know. I feel kind of comfortable just leaving it as is. If worst case scenario, it's like if I wanted to do something, I would maybe just shift the distribution on it a little bit. I don't think I really want to do either, because we are giving them relatively bold margin growth assumptions. So one thing where it's like I don't want to give them everything. You know, we were reasonable and fair in the sales to capital ratio, which is good, but then we're relatively bullish on their margin expectations. Essentially, assuming it's going to go in line with industry grouping relatively quickly. They do obviously have they have kind of shown that they're very capable of maybe doing that, but the question is obviously how much of that is an outsized year in this particular case. But the outsized year typically shows up more in the sales to capital ratio than it does in margin on the back of the revenue growth. But it's like, if they actually do sustain revenue growth in this year, it also comes down to a question of how fast do they grow their R&D relative to SG&A. SG&A obviously grew at a huge clip. R&D did not grow at quite the same clip, but we give them the benefits of R&D because of the way we capitalize R&D. So essentially, it's like the more they grow R&D each year consecutively, the better it comes out for this particular form of profit that we calculate. $139 million in profit versus $103 million in profit. So that's like that's our own adjusted profit. Like 18, 23, 139 versus negative 13, negative 8, 103. So according to the way we calculate profit, they've been profitable for 3 years. 1 year. Not GAAP profitable. We have the analyst model coming to 24% growth in profit CAGR, which, like I said, that kind of compares to the 10 to 11% that's put here on the analyst expectations on Yahoo, but that's EPS, so that doesn't take into account the issuance of shares. And so I think that actually sort of makes sense, because that means that they had 24% and then perhaps they put out 50% more shares. Then that would actually work. That would sort of work out to a sort of similar number. Makes me feel reasonably confident about this 15% number, which my main number is kind of centered around as well, so I think that's good. And then we are using the 3-year average for the base year, which basically assumes that no matter what in the next year, it's going to collapse back downward and then kind of grow back up, which I think makes a lot of sense as well. Could maybe argue that it should be 2-year average. A little bit, gives them a little bit better. I think I'd rather do that than boost the revenue expectations further. So pretty good distribution of value coggers. All right, so let's adjust for default risk real quick. I don't think they have a lot of, because they don't have a lot of debt, but Okay. So I think that's pretty much it. If I give them any bit more, I feel like I'm giving them a bit too much. It's a pretty decent set of outcomes. Um, it depends on a lot of growth. That's definitely for sure, and I think that the growth definitely depends on their ability to keep acquiring things. But they do have a very strong brand. Like I said, I'm a huge fan of their products as is, but we'll have to see if that all comes out to. Yeah, ticker CRSR, Corsair Gaming. Computer peripherals and components and other gaming system parts. U.S. Treasury is 1.5% today, with a mature market equity risk premium right now of 4.78%, which gives a expected market return of 6.275%. I have a discount rate for them of 8.76%. They don't pay a dividend. Recent IPO, so we don't have sales for them from 5 years ago. I could probably dig deep if I really wanted to on that, but just based off the numbers that was in their prospectus and their S1, don't really know that exactly. But either way, sales in the most recent year of 1.7 billion and sales to capital of 1.8 relative to industrial grouping of 1.46, which is possibly partially on the back of the strong sales to capital that they had in this most recent year, because that sales to capital is actually like a 3-year average or 2-year average. I can't remember which one I went with. Returns on invested capital of 13.49%, which is pretty strong. Debt to equity ratio very low of 12.1%, and pretty much no default risk, really nothing significant, just 1.06 or 1.07%. R&D adjusted profit margin of 5.13%, which is growing rather rapidly, and that's actually a 2-year average, because in the most recent year it was more like 8%, versus the industrial grouping that we have for them is 16% or so. So obviously a lot of more room to grow on that side. They do have low profit margins relative to their industrial grouping, but high sales to capital relative to the grouping, which, like I've said before, it's like companies are usually one way or the other in that sort of logic. They have not the greatest profit margin right now, but they do have a high sales to capital ratio. But those two things might balance themselves out over time. Current profit of about $139 million, adjusted for R&D. They're currently selling for $33.42. In our probability distribution, we chose not to mess with it. We're just going to kind of leave it as is, and we just did some other things. We're pretty bullish on potential revenues for them. In the worst case scenario, we're assuming $2.1 billion in 5 years of revenue, but on the high end, we're assuming possibly $4.2 billion in revenue, with a probability distribution expected value of about $3 billion or so. So we're assuming that they almost double their revenue in the next 5 years, which, considering they've done extremely well in their revenue in just 2 years, that we've been able to look at very closely, that seems to make sense. But that does definitely depend on their ability to keep acquiring small companies and integrate them into their environment and their little world of components and parts and stuff. But they've done a very, very good job of integrating new companies into their product systems and to market them. So that gives us an expected revenue growth rate of about 12.13% CAGR per year. Obviously, a lot of that might be fronted, because, as I said before, they're expecting more in the 20s this year. It's just a question of whether or not that's sustainable or not, and analysts certainly seem to believe that that's going to drop down to maybe like single digits next year, and then maybe there's another 2-digit number after that. Who knows? But the point is, over the 5-year period, smoothed out, we're assuming about a 12.13% growth in sales. And we're assuming that the sales to capital ratio does come back down a little bit closer to the industrial grouping, but we assume that they're probably going to still have higher than their industrial grouping on overall, on an expected basis of 1.61. Returns on invested capital, we assume, are going to climb rather precipitously, because they probably will issue new shares, and hopefully they'll issue new debt if they can get good terms for it. But we expect their revenue to grow rapidly and their profit to grow rapidly relative to those things. So overall, their returns on invested capital should climb dramatically for the next few years, which is what you would expect from a very strong brand. As I was just saying, we expect them to issue a lot of new debt. If they don't issue new debt, that actually hurts their returns pretty significantly. So, but again, that's also dependent on their ability to get good terms for the debt. So obviously you shouldn't issue bad debt, but if they can get interest rates of 5% or lower, and ideally long maturities, then they should probably go for it, as well as ideally terms that allow them to call back their debt. But that depends on a lot of the factors. But considering their brand power and the growth of their equity in the first year of their existence, I think it's probably not going to be hard for them to get good terms. So hopefully they do issue as much debt as they do equity moving forward. Either way, the default risk, we don't expect it to be very high, only about an expected value of 1.19% per year. It's pretty typical, nothing major in either direction for them. Profit margins adjusted for R&D, we're expecting possibly to climb to 15%, which would put them below their industrial grouping, but we're still going to leave their sales to capital ratio higher than industrial grouping. So overall, that kind of balances out. We're essentially assuming they become synchronous with the computer peripheral market as far as both those go. But considering their strong market share, we think that's a pretty fair assumption to make. And on the expected basis, their adjusted profit we expect to be about $477 million in 5 years. With the discount rate that we're using, we get a present value of $49.38, which is 47 to 48% higher than its current price, and 5-year forward value targets of anywhere from $31.98 to possibly $175.30 per share, and on an expected basis that comes to $75.15, which based off the current price it's selling at gives us an expected CAGR of 17.58% per year, which is pretty appealing. As I was saying before, when I had was earlier in this stream, as well as to the person that had initially suggested in the comments that I should take a look at Corsair. I had already taken a look at Corsair in the past, but it was with a different model, which didn't give me the ability to manipulate the numbers and create such variability in the outcomes as I have the ability to do now, which definitely makes it look much more appealing. This is definitely not too shabby at all. Definitely have to consider it. Like I said, I'm a huge fan of their brand, so that definitely makes me feel pretty confident in that. And the only thing, like I said, that makes me question it is just really about, you know, maybe the potentiality of this particular outcome is maybe a little bit too high, because this is a CAGR, not just a 1-year figure. So perhaps this is a little bit too high, perhaps this is a little bit too high, and you know, so maybe this is like this assumes a lot of things go really well. This is maybe a little more fair basis assumption, and then I mean these are definitely much more fair basis assumptions, but point is the CAGR actually ends up pretty good in most of these cases. The only situation where you end up possibly losing money over a 5-year period is in the worst case scenario, which basically assumes that their margins collapse back down, sales to capital ratio also collapses back down, and that they grow at significantly lower than the expected rate for where they're currently at. So I mean, I would say this is just as unlikely as this, and which is part of the reason that they're weighted the same way they are. So like I said, you could shift the probability distribution around, but I definitely feel like this is a pretty reasonable outcome to expect, which still has a pretty good return. So really it's just leaving some potentialities for some much better numbers on the upside. But yeah, it's Corsair Gaming. Short-term pricing metrics, because it only has a couple years, is definitely wrong and all over the place, so it's not really a very useful technique for this. But again, that's mostly just the icing on the cake when it comes to my valuations. Value CAGR is the most important thing. So 17.58% per year is definitely not too shabby at all. Definitely gonna have to consider it. Either way, so that's gonna be it for us today. Like I said, a relatively short stream today, but it is what it is. It's very little numbers to actually go into because it's such a new company on the market. But hope everybody enjoyed it, and please subscribe to the channel if you're not already. Like the video if you haven't already. We will be back on Wednesday. I'm gonna have to skip my Monday stream again because of medical appointments, but not sure what we're gonna be doing on Wednesday, but we'll be doing something on Wednesday. But most weeks we stream 3 times a week: Monday, Wednesday, Friday at 10:30 a.m. Eastern. And leave your comments below if you have suggestions for things to maybe get to in the future. No guarantee that I will, but I very well might. As I said, this one was pointed out by somebody in the comments, even though like I said, I already had data on it. But point is you know, I very well might do what you suggest. So please subscribe, like, comment, all that. Catch you all next time.